Record silver prices, they just pulled in over $140 million in revenue, and somehow this company still managed to report a net loss. You are listening to Earnings Unscripted. It is May 29th, 2026, and today we are breaking down Silvercorp Metals, ticker SVM. They're, the fourth quarter of fiscal 26. And Miro, how do you pull a clean $100 million in operating income and still end up in the red?
You just have to be spectacularly bad at derivative accounting. That is really all it takes.
Well, before we unpack that specific talent, a quick reminder that we are just two friends looking at the numbers. This is definitely not financial advice, just our personal takes. Okay, so justify this math for me.
Right. So look, the core mining operation is practically on fire. Like you said, revenue came in at $147.4 million. That is a 17% bump, actually a 17% just from the previous quarter. And operating income from the mines was exactly $100 million. It is basically a cash printing press because they're selling silver at nearly $79 an ounce.
$79. With margins like that, reporting a loss is almost impressive.
Right, except the loss is not real. They reported a GAAP net loss of $0.7 million, basically a flat zero, a fraction of a cent per share. But if you back out the paper accounting, specifically this massive $60 million mark-to-market hit on their convertible notes, their adjusted net income is actually a very healthy $59.3 million.
And investors clearly saw right through the accounting glitch. The tape has been remarkably strong. The stock bapped up Tuesday after the print, and even today during the delayed earnings call, it just sustained that upward momentum, pushing toward 1270. No panic at all over the headline loss.
No, and they should not panic because management finally amended those convertible notes in March. They removed the cash settlement option. So this entire, this derivative nightmare is structurally over. Going forward, the actual cash generation is going to match the income statement a lot closer.
Thank goodness for that. But, even with silver bailing out the spreadsheet, they had to fight pretty hard on the ground. I was reading about their El Domo build down in Ecuador.
Right, the mud.
The mud?
Yes.
They got hit with this exceptionally prolonged rainy season. They have almost 400 people on site just struggling to build non-contact water channels and just put up prefabricated sleeping modules so the next crew has a dry bed. It's a great reminder that mining is a deeply physical business. You are literally fighting the jungle.
You are, and they are taking all the cash from the Ying district and throwing it into that jungle. Plus, they just dropped another $60 million in May to secure gold licenses in Kyrgyzstan. The whole map is changing, but before we get totally lost in the global pivot, we really need to look at what's happening underground at the core Ying operation.
Good point. Let's get into the details on that because the production volume numbers are actually hiding a pretty big trade-off.
Yes, exactly. They are completely changing how they physically pull the rock out of the ground. For years, they relied on this highly selective, very labor-intensive method called, it is called resuing mining. You essentially send people in to carefully chip out these very narrow veins of high-grade ore, but now they are transitioning to what they call shrinkage mining.
Which sounds like a terrible marketing name, by the way.
It really does, but functionally it just means mass mechanization. They blast and scoop much larger sections of the tunnel. And the financial impact of doing that is, it is massive. It dropped their production costs to about $78 a ton. That is down roughly 8% year over year.
Okay, yes, but if you are just blasting larger chunks of the wall, you are obviously getting a lot more waste rock mixed in with the silver. So the actual grade drops.
Precisely. That is the exact trade-off. It's the dilution effect. You have to push way more tonnage through the processing mill just to get the same amount of final metal. Lon Shaver actually touched on this on the earnings call. He said, The improvement reflects a 43% and 2% increase in tons mined and milled as continued mine mechanization and greater use of that cost-efficient shrinkage mining method boosted productivity.
Productivity is definitely doing a lot of heavy lifting in that sentence.
Oh, absolutely.
Because their total silver output actually went down this quarter. I think they only hit 1.46 million ounces, down a few percent from Q3.
Right, down 2.6%. So they're moving 40% more dirt just to pull slightly less silver out of the earth. But because silver prices are hovering near $80, the unit cost savings on moving all that rock absolutely cover the gap. It's purely a volume game now.
I see. It's just a brutal physics problem at this point. They're weaponizing their processing capacity instead of being surgical about the rock itself.
Exactly, and that explains why they're spending heavily to build Millburger 3, to handle even more of that lower-grade volume.
But wait, this brings up the one number that really confused me. You said the core operations are basically a cash printing press right now, but their operating cash flow fell pretty hard. It went from over $130 million in Q3 down to about $90 million this quarter. A 32% drop does not scream printing press.
Right. So that is probably my favorite detail in these filings. It is a complete accounting illusion.
Haha, of course it is.
If you just scan the headlines, you would assume operations decelerated, but they absolutely did not. What happened in Q3 is they secured a massive upfront deposit from Wheaton Precious Metals.
Right, the streaming deal to finance the El Domo build.
Right. It was a $43.9 million cash advance. And because of how the accounting rules handled deferred revenue, that financing injection gets classified as operating cash flow. So it massively inflated the Q3 baseline.
Oh, wow. Let me make sure I'm processing this right. They basically borrowed cash against their future production last quarter, booked it as operating cash, and then this current quarter simply had to look weak by comparison.
Bingo. If you strip out that Wheaton advance from the math, the underlying cash generation from the mines actually hit a pure operational peak in Q4. It was the strongest organic cash flow we have seen from them.
That is wild. Between the convertible note hiding $59 million in real income and then the streaming cash totally skewing the quarter-over-quarter cash flow trend.
The entire income statement is essentially wearing a disguise right now.
It really is. You have to fight the GAAP numbers just to find the actual business. And the actual business is clearly gearing up for a massive expansion cycle. So where does this leave them heading into fiscal 27, especially with all these global projects moving at the same time?
It leaves them writing very large checks. Management just outlined a whopping $141 million in capital expenditures for fiscal 27. So they're going all in.
Wow. Okay. I mean, that is a massive chunk of their cash reserve. What exactly is the money going toward?
A big part of it is mill number 3 at the Core Ying district. They are budgeting roughly $23 million just to get that construction started. Lawn Shaver mentioned on the call they expect to commission it a year from now in the first quarter of fiscal 28. That pushes capacity up to 6,500 tons per day.
Right, which they completely need to offset the dilution we were just talking about. It feels like they are essentially outrunning their own geology by just building bigger shovels.
Exactly. The volume has to keep scaling. But look, that brings us to the real outlook risk here. You have mill construction in China, the new gold assets in Kyrgyzstan, and, well, the Ecuador situation is getting complicated again.
Right, the El Domo environmental license, because lower courts approved it, but I saw that a fresh appeal was just accepted a few weeks ago in late April. So that is not totally secure.
No, it never is. That kind of legal friction could easily delay their commissioning timeline. And honestly, I think they know they are walking into a highly volatile cash burn cycle, which is probably why they just filed for a dual listing on the Hong Kong Stock Exchange.
Oh, hunting for a completely different pool of capital. That is super pragmatic. Western markets have essentially starved a lot of these mid-tier mining companies lately.
Very pragmatic. They need a friendly audience who understands resource plays, especially if they hit snags with that massive Capex budget.
So basically, they finally fixed their income statement. They're generating real cash today, but they're throwing it all into the absolute deep end to become a diversified global operator.
It's a bold bet. The transition from local miner to global player it's historically where the wheels fall off for a lot of these companies. Let's see if they can manage the gravity.
That is perfectly ominous, Miro. I love it. I guess we'll see how the build-out is actually going next quarter. We'll leave it there for today.
Thanks for listening, everyone.
If you want these earnings deep dives to just naturally show up in your feed, go ahead and follow the show. As a quick aside, we use AI to help generate these episodes, which is exactly how we're able to turn those incredibly dense regulatory filings into a real conversation so fast. We would really love to hear your thoughts or what tickers you want covered next. So drop us a note at earningsunscripted@datamadness.ca or grab the X link right in the show notes.
See you next time.